The real estate markets around the world are experiencing a decline after years of steady growth. As per recent data from the Organization for Economic Cooperation and Development, OECD, two-thirds of the economies for which the OECD tracks housing prices saw declines for their latest quarter of available data. The decline highlights how real estate markets are adjusting to rising interest rates as central banks attempt to contain inflation. In the United States, for example, the Federal Reserve has increased the target rate to a range of 4.5 to 4.75% from near zero a year ago, the fastest pace of rate increases in 2 decades. This has resulted in a sharp increase in the average 30-year fixed mortgage rate, which rose to a 2-decade high of 7.1% at the end of last year. Interest rates play a critical role in driving house prices, along with income and population growth on the demand side, and various supply factors such as construction costs and regulations. Based on cross-country evidence, it is estimated that each 1 percentage point increase in real interest rates slows the rate of house price growth by around 2 percentage points. Before the recent tightening cycle, interest rates had been on a downward trend. Lower rates led to an increase in housing demand by bringing down the cost of borrowing to finance the purchase of a house or to build on existing homes. Now, the cycle has been thrown into reverse. Each percentage point increase in the mortgage rate raises monthly interest payments for the typical U.S. homebuyer by $100. And the effects can be even more severe for buyers in countries with a prevalence of adjustable rate mortgages. The extent to which the decline in housing prices continues will depend on whether the rate increases by central banks have already curbed inflationary pressures. The International Monetary Fund's latest World Economic Outlook update predicts inflation to be lower this year than it was in 2022 for around 85% of countries. Global growth is expected to slow from nearly 9% last year to around 6.5% this year and decelerate further next year, driven by the impact that rate increases have proactively had on easing the imbalances between demand and supply. If central banks slow or halt rate increases, housing prices should see greater stability. Meanwhile, across the world, house prices are breaking records, but this time it's because of how fast they are falling. According to recent reports, houses in Stockholm are now selling for 20% less than their peak. Sydney prices are down almost 14% over the year, while in San Francisco they are down 15%. In Auckland by almost 22%. And in Toronto by 16%. Germany has registered its biggest 6-month price fall in years. While in France, forecasters are expecting declines of 5% to 7% this year. Following areas of strength in Spain, the first price declines are being reported in Majorca and Ibiza. In the UK, home values have fallen by 4.2% or 3.2% since their peak in August last year, according to Halifax and Nationwide, respectively. These declines may look mild compared to some of the other regions, but they are significant nonetheless. At its simplest, the decline in housing prices around the world is due to the cost of money. The era of near-zero interest rates, which made it cheaper than ever to buy a home, is over, at least for now. The Bank of England has raised rates from 0.1% in late 2021 to 4% today, with a corresponding rise in mortgage rates. In the United States, average long-term mortgage rates are now above 6%. A year ago, they were below 4%. Some of the price declines are the result of the race for space, as companies try to outcompete each other by offering larger and more modern facilities to tenants. In addition, the rise of e-commerce has also contributed to the oversupply of warehouses and the resulting price drops. As more and more consumers opt for online shopping, companies are finding it necessary to expand their warehouse and logistics networks to keep up with demand. However, while oversupply may be causing some temporary disruptions in the commercial real estate market, it is not necessarily a cause for concern in the long run. In fact, the trend towards e-commerce and the growing importance of logistics and supply chain management may actually lead to increased demand for warehouse and industrial space in the future. As such, many investors and developers are viewing the current situation as an opportunity to acquire assets at a discount, with the expectation that prices will eventually rebound as the market adjusts to these changes. Ultimately, the impact of oversupply on the commercial real estate market will depend on a variety of factors, including the strength of the overall economy, the pace of technological change, and the ability of real estate investors and developers to adapt to evolving trends and market conditions. While oversupply may create short-term challenges for some players in the market, those who are able to navigate these challenges successfully may be well positioned to thrive in the years ahead. In conclusion, The recent decline in the global real estate markets is a result of rising interest rates that central banks have implemented to contain inflation. The cycle of near zero interest rates, which boosted housing demand, has now reversed, leading to a decline in housing prices. Interest rates play a crucial role in driving house prices, and each percentage point increase in the mortgage rate raises monthly interest payments for homebuyers. The extent of the decline in housing prices will depend on whether central banks continue with their rate increases to curb inflationary pressures. However, if they slow or halt the rate increases, housing prices should see greater stability. While the decline in housing prices may look mild in some regions, it is significant and highlights how real estate markets are adjusting to the new interest rate environment. Thank you for joining me today.